Welcome everyone, and thank you for joining us today. We will be getting started here in just a couple of minutes. Let us know that you can hear us by opening up your Q&A panel from your Zoom control panel and typing in what state you're coming to us from. Throughout our presentation today, we will be launching polls throughout to give you a little bit of exercise with our topic today. Separately, if you have questions about the content that we're covering, we will also be hosting a live Q&A at the end. If you have separate questions that come up throughout the presentation, feel free to type them into this Q&A box where you're typing your state. At any time during the presentation, feel free to type in those questions. We'll answer them as we go if we can, or we'll save them for the end for a little bit of discussion. Again, thank you everyone for joining us today. We will give just a few more minutes for folks to join us. We'll be starting in just a couple of minutes, but please do let us know that you can hear us by typing in what state you're coming to us from in that Q&A panel. Looks like we've got folks from all over today: New Jersey, Florida, Colorado, California, coast to coast. Fantastic. Thank you everyone for taking the time to be with us today. We'll be covering some great content today, something that lots of folks like a little bit of clarification on: closing calculations. It's a complicated one, so thank you so much for taking the time. We're gonna give just a couple more minutes here for folks to join us. Once again, if you're just popping in now, please do let us know that you can hear us by typing in what state you're coming to us from into the Q&A panel found in your Zoom control panel there along the bottom of your screen. All right, Washington, D.C., Missouri, Kansas, Colorado, Florida, all over the place today. Wonderful. Give just another minute here. All right, Tennessee, Maryland, Oregon. Wonderful. Thank you all for taking the time to join us today. All right, we're going to go ahead and get started. Welcome everyone. Again, thank you so much for taking the time and joining us for today's webinar. We hope that you're all safe and healthy, and we appreciate you taking this time out of your day today. You'll be able to participate in a live Q&A at the end of the webinar. So remember, if you have any questions during the presentation, please feel free to type them into that Q&A panel that you find in your Zoom control panel along the bottom of your screen. And if you miss anything, please don't worry. We will send a link to the recorded session when it's available. Throughout the webinar, you'll also see poll questions related to the webinar topic. You can respond to those from the device you're using to view the webinar. My name is Jennifer Sterling, and I'm an instructional designer at the CE Shop, the leading provider of online real estate education. Today, we're reviewing a topic that is difficult for some students: closing calculations. Our presenter, Charlie Alfordish, will walk you through how these calculations are made. Charlie is a longtime real estate curriculum developer and instructor, and is a certified Louisiana pre-license education instructor with additional certifications specifically in distance education. Now, without further ado, we'll turn the session over to Charlie.
Wait a second, I'm being told I'm muted. Am I muted or unmuted?
You are unmuted.
Okay, thank you. I was talking away, noticing, oh, wait, nobody's hearing me. Good afternoon, everybody. Glad y'all can join, and hopefully I'll shed a little light on some problems you may or may not be having with closing. It's not as bad of a topic as you think. I'll give you a little, when we get to some of the poll questions, I'll give you a little tips on how you can at least narrow down your choices as you're going along, as well as how to take care of them. So to start this off, to kind of see where everybody is, we're going to have our first poll question, which is easy. I don't know who you are, so this is all anonymous. Just gives me an idea of how far along you guys are. Give y'all about another 30 seconds to tap in. let's go ahead and let y'all see the results because I've got about 85% that have answered so far. And pretty 28% of y'all, congratulations in whatever state you're in because they've got you clicked on the I have finished. Hang in there for the ones that are for the 24% that are at 75%. For 20% that have just started, hey, it's a journey. Enjoy it. 25 and 50, keep it up. You're doing good. Because I know it doesn't, I know with this being multiple states, there are different hour requirements. I don't know everybody's. I know in Louisiana, it's a 90-hour requirement. So it takes time and effort and a commitment on your behalf. So with that realm, congratulations and appreciate y'all's efforts. So now we're going to go ahead and move on into the program. There we go. Okay, now one thing about the test. Once again, like I said, from different states, there's a different amount of questions that you have, which I think is why the PSI and Pearson and all, whichever one you happen to have, and AMP have just gone to putting percentages. Calculations are 10% of your test. So using Louisiana for an example, we have 80 questions in Louisiana. You're going to have 8 questions that involve calculations. If you have 100, 10. And 70 is the magic number percentage-wise to pass. So even if you missed all of the questions that involve calculations, you'd still be okay. You'd still have a bunch more leeway before you would fail. On the average, I would say, most people tend to get at least half because sometimes your calculation questions aren't really calculations as far as pulling out your calculator to figure it out. If you get a question that says your home is worth $100,000 and you owe 80, what's your equity? 100 minus 80 is 20. So you just click in on the answer and you won't even realize that you just did a math question. I will tell you that I have not taken the test this year or last year. So I've taken it about 15 years because in Louisiana, they've allowed me every year I can go take the salesperson's test. I can tell you that over 50% of the answers to math are C. So if you want to just shy away and you have no idea, press C and you got a pretty good shot at it. So we're going to be talking about the closing statement. This is a time that I'd almost love to grab my wife and throw her in because she's in the mortgage business. But it's really easy to look at when you start looking at what the buyer has to bring, which, the buyer or the seller, whichever one you're going to be representing, you're going to be talking with them on this. From the buyer's side, they have to have the purchase price, whatever debit and credits are there, and that brings the amount that they need to have to close. And the purchase price, I can say in 21 years of being an agent, I've had a couple of people just bring cashier's checks. But for the most time, it's somebody's got a loan. And that's good because as long as all the guys are dotted, T's are crossed, and signatures are flying on the closing table, you're in a good place. As far as the seller, the amount that they receive is the purchase price minus any debits and credits that are going to be on their closing statement, of which usually the seller's biggest number that's on there, that's going to be a debit that they have to pay, is paying off the mortgage that they still owe on their house. But we'll touch a little bit on that as we go through. So I say the closing calculations, debits and credits, prorations, which we'll go over a couple of questions, polling questions on that, which will be kind of fun because when we look at the answers, I'll tell you how to identify things that are no way they could be the answer. to where you're at least down to two choices. If not, gee, there's only one obvious choice to make. The seller's proceeds, because sometimes you have a seller that, hey, as long as when we add up everything, I get this much in my pocket, I'm a happy camper. So you need to know how to get into that. Buyer funds needed at closing. We'll talk a little bit about that. And then this is one that you may see a question on, but usually it tends to, if there's, I think, about 60 of y'all, maybe about 3 of y'all will see a question on transfer fees and conveyance taxes and revenue stamps, because some states don't even, like Louisiana, we don't even have it, except for in Orleans Parish, where it's just a flat fee. So, I said, we'll be touching on all of this, and if you have questions, either jot them down or type them into the Q&A part, and we'll answer it when we get through everything. So the first thing you need to know are debits and credits. If this sounds like accounting 101, it's close. From the debit is an amount that you have to pay at the closing. And when I say you, the buyer or the seller. On the credit side, it's an amount that's going to be received or is paid on your behalf at the closing. That sometimes in the contract, you might have the seller agreed to pay $1,000, just to pick a random number, of the buyer's closing costs. So that would show up as a credit on the buyer's side because they are not having to have that come out of their pocket. And it's going to be, as you might expect, specific to the party that's named. So here we go with our first polling question. The purchase price, here we go. Purchase price is what to the buyer and a what to the seller. Give y'all about a minute. Okay, let's see how y'all look. Okay, we got 88% of everybody that answered went with a debit to, have to pull a little thing out of the way of my question. It came out as a debit to the buyer and a credit to the seller. And the correct answer was 3 cheers to the 88%. Debit to the buyer and credit to the seller. Fortunately, there were only 2 people that went with the answer of D, debit. The one thing about this, whenever you see both people on there, both the buyer and the seller, it's never going to be a credit. It's never going to be a debit. One of them has to pay, one of them has to receive. So, you've at least got a 50-50 shot coming to this one if you're not sure. And gee, look at that. Just like I was telling you before, correct answer was C. Okay. So good job on that, guy. You did wonderful. Here's another one. An existing loan that must be paid off is a what to the what? Okay, we're kind of split all around on this. Let's look at the results. The majority, 58%, went with the debit to the seller. We have a few people that went with the credit to the buyer, a few more that went for debit to the buyer, and some people that went to credit to the seller. If you're talking about an existing loan that has to pay off, A and B are automatically going to be wrong because the seller is the one that has the existing loan that has to be paid off. So the 50-50 here was between C and D, of which the correct answer was a debit to the seller. Because once again, anytime you have to pay out, it's a debit. And there's going to be no entry on the side of the buyer on this because it's not the buyer's financial obligation. So good job. Let's poll again. The amount of the loan that the buyer borrows to purchase is a what to the who? Okay, and we will see how y'all did on this one. Got 57% of y'all said a debit to the buyer. And once again, we got a few people that were doing the debit to the debit to the seller or the credit to the seller. The amount of a loan that the buyer borrows, it's in that part is even in the question on this one. So you know it's got to be something to the buyer. The seller isn't going to be getting a loan taken pay off. So on that one, the correct answer will be the credit to the buyer. Okay, here's the part that tends to drive everybody a little bit crazy: prorations. These are shared obligations, partial because when it's a proration, it's going to be split numbers. The two words to look for if they like to go in a question, if they like to go technical on you, is accrued, which if it's an accrued amount, that means the bill hasn't been paid yet. Basically, the buyer will pay the seller's share later. So what that means is if to look at it as a not paid, let's say it's December, well, this will be an extreme example. You're going to closing today on December 17th. Now, what happens is they'll look at the full year, and I will be going over more detailed, but because it hasn't been paid, the bill is going to be coming to the buyer. So the buyer needs to get from the beginning of the year to today to so that the percentage that is owed by the seller gets paid by the seller. So that will always be a debit to the seller because it's going to be a charge and a credit to the buyer. Prepaid means that when you paid your taxes at the end of the year, you might be paying taxes now if you haven't owned your home. Your taxes may be being paid for next year in advance. In that case, when the seller comes to buy, the rest of the year has already been paid. So they're going to have to give a prorated amount of what the taxes for the whole year were back to the seller. So in the case of prepaid, you're looking at a debit to the buyer, a credit to the seller. So the major things, there are some assumed things here that I will tell you about after I hit these bullet points here. You're going to be looking for whether it's accrued or prepaid. You're going to be looking on whether it's a statutory banker's year, which means it doesn't matter whether there's 28, 29, 30, 30, actual calendar where every day of the month actually counts, and it's a 365-day year. The period of time that the charge is covered, which means when are we closing this thing? And which party owns the day of the closing. So if we're closing today, is the buyer paying those taxes or is the seller paying those taxes? So when you look at these, a lot of times if you do get a proration problem, they may not give you all of this information. So here's how this works. If they don't tell you it's accrued or they don't tell you it's prepaid, it's going to be accrued is what you're going to use. If they don't bring up the calendar, you're using a statutory banker's year. The period of time the charge is covered, they got to tell you when you're closing. So that one is always there. As far as which party owns the day of closing, if they do not tell you, the seller will be paying the day of the closing. So, so remember the things that, if they're unspoken, you need to know. So the things that are commonly prorated, taxes. If they're prepaid, it's going to be a debit to the buyer and a credit to the seller because the seller is going to be paying the buyer for the rest of the year. Going to be paying the buyer for the rest of the year if it's accrued. And okay, Lindsay, I see you raised your hand, and I will defer on this because I'm not sure if you need to type a question or not. If my support in the back will let me know, it'd be great.
Just a reminder to our students, if you do have questions, please go ahead and type them into that Q&A panel. And we will either address them as they come, or we'll have time at the end for the live Q&A and we'll address them then. Thank you.
Okay, and if by some chance you think that it's one that needs to be addressed now, feel free to interrupt me and let me know and I'll run with it. Homeowners and condo fees, same thing. And what the thing is with that, I can tell you in 21 years, of which 15 of them I've taken the exam, I have never seen homeowner and condo fees put out there. But it works the same way. Debit to the buyer, credit to the seller if prepaid, debit to the seller, credit to the buyer if accrued. Interest, would come up if you're assuming a loan or if you're dealing with a borrower and the lender. And usually it tends to be they like to play with taxes. That's your most common proration question. Property taxes. So you do need to know a little bit about this, and depending on how your curriculum goes out through this, it's in one of the sections. That much I know. You have an assessed value, and that gets multiplied by a tax rate. And that tells you how much your annual taxes are. Your taxes are always expressed as mills. Sometimes they will tell you that it's 11 mills per. 11 mills is your thing. Other times it'll tell you it's expressed as $1 per $1,000 of value. So if you have that, we'll just stick with $1 to make it easy. So if you have a $100,000 property, it's going to be $100 worth of taxes because there's 100 thousands in 100,000. As a rate or amount, pretty much the same thing. Or it could be per $1,000, where you just divide the assessment by 1,000 and multiply it by the rate by 100, divide it by 100 and multiply by the rate that they give you. It looks a little bit easier when you see it like this way. House is assessed at 403,000, is purchased at for 400,000. The tax rate is 12 mils. How much are the annual taxes? To find out your annual taxes, it's the assessed value times the tax rate. And here's the thing. This is more common in a math question than it should be, because I don't believe in my mind it's a little bit of trickery as opposed to it's testing your knowledge. What you paid for the property does not matter. It's the assessed value. So that 400,000 is just there. So if by some chance you go wrong and you decide to do your calculations on the 400,000, that calculation will be one of your 4 choices. So you will miss the problem, but you'll feel good about missing the problem. So you're looking at 403,000 times 12 mils to come up with your annual taxes. So if it's 12 mils, that's per 1,000. So you're going to do 403,000 divided by 1,000 times 12, which comes out to 403 times 12. So your annual taxes are going to be $4,836. So let's play with another poll question. Property with annual real estate taxes of $4,800 closes on April 27th. Closing date is charged to the buyer. Charges are based on a statutory year. Seller paid taxes for the calendar year on January 15th. How will the closing statement address taxes? I'll give you about another 30 seconds on this one because I know y'all are having to use your calculators a little bit for this. Okay, I know this one's taking a little bit of time for y'all to work out, but if you want to keep working, but we're going to go ahead and close out at this point because we've got over half of y'all that have answered. So let's see how y'all did. Okay, 47% went with 1546 credit to the seller and 3239 debit to the buyer. We had 14% that went with B and 11% that went with C and 28% that went with D. And the real answer is B, 3253 credit to the seller, 3253 debit to the buyer. Okay, before we click over and show the work on the calculations on this, some helpful hints which throw you back. I'll be going back to Accounting 101 if many of y'all went, took any accounting classes. When you're doing something that involves two parties, the amount of the debit and the credit have to be the same amount so that your sheet balances. So you automatically can rule out A and D on this question. It has to be the same amount. So now you're looking at either B or C because you're down to a 50-50. So that you don't use your phone a friend on this, easy way to avoid your calculator, you got $4,800. It closes on April 27th. It says the charges are based on a statutory year that the seller has already paid for on January 15th. So you're going to be looking at from April 27th through the end of the year. That's more than half the year, which means it's got to be more than $2,400, which means your only choice is B. You will always, in this type of a question, have two numbers that add up to the total tax, or in this case, $1 shy of the total tax, because it was rounded. So you know it's going to be one of those, and as long as you know if you're counting more than 180 days or less than 180 days, you can migrate to the right answer without calculating. This is what people like me do in their spare time. They figure out ways to do the math without doing it. So let's go ahead and work it out. You've got 4,800. You're going to be dividing by 360, which gives you $13.33 per day that you're paying on your taxes, or that someone paid on their taxes. So you're looking at 244 days, which are the days the seller paid for the buyer's taxes, which is going to be May, June, July, August, September, October, November, December, which is 8 months times 30 days is 240. And then you've got the 27th, 28th, 29th, and 30th to add on to there. So that's how your 244 days came up. Multiply it by 1333, and you got $3,252.52. So you round that little sucker up to 3253, and you got your right answer. And yes, got to say that. Credit to the seller, debit to the buyer. Calculating.
Charlie, I'm so sorry to interrupt you. We do have one question that is germane just to that slide. So rather than addressing it at the end, it might be a little easier to address it now. We have a question about how we got 244 days again.
Sure. The 244 days is you have to figure out how much how many days you're looking at from the date of the closing. Since this is paid in advance because it's telling you that the taxes were paid for the calendar year, you're going to be counting from the closing date through the end of the year is what's going to get prorated because that amount is owed back to the seller. So you've got the 4 days of April, the 27th, 28th, 29th, and 30th. And then you have 30 days for May, June, July, August, September, October, November, December, which is 8 months. So 8 times 30 days is 240. Add those 4 days back for April, and that's your 244. So
thank you so much, Charlie. Very much appreciated.
Oh, no problem. Thank you for the question. That was a good question. Calculating simple annual interest. How much is really kind of an easy thing. It's the amount that you borrowed times the interest rate tells you how much you're paying in interest for the year. If they ask it, and there's 3 ways you can get asked a question like this. It might take and ask you for what the interest rate because you paid a certain amount of interest on a certain loan amount. In that case, it's the dollar amount of the interest divided by the loan amount gives you the interest rate. If you get asked about how much is the loan, you just take the interest that it'll tell you in the question and divide it by the interest rate, and that'll give you the loan. So, it's wise in the conversation to basically give you the equation because there are people that live and die by the equation. Other people just want to see numbers because it works better in their mind. So, we do it both ways so everybody gets a chance to see. So, a lender receives $18,000 annually in payments for a straight loan at 4.5% of interest. What is the amount of the loan? So, in this case, we're looking at the middle one there, the annual dollar amount of interest and the loan amount. Or actually, I'm saying that wrong. Looking at the annual dollar amount of interest and the interest rate, and we want the loan amount. So, I'm going to backtrack a second because I thought that we had the equation sitting in there, which I apologize, that's not in there. So I'm just going to go back one more time and just tell you, if you divide 18,000 divided by 4.5%, and since I don't have a calculator in front of me, well, actually I do. Give me just 1 second. So if you're taking notes while you're doing this. This is kind of showing you that I can't multitask very well because I'm trying to talk and do a calculation at the same time. No. Okay, just so you know, $18,000, which is the annual amount of interest divided by the interest rate, 4.5%, means you have a $400,000 loan. So it's a little calculation on the fly there. Okay, interest paid in advance on a new loan. Buyer goes to closing on June 7th. The new loan is for $300,000. I'd say, wish you could get a new loan for $3,000 on a new home at 4% annual interest. The first regular loan payment is to be made on August 1st. That payment will cover interest for the full month of July. Interest must be paid for June, must also be paid at the closing for June 7th through June 30th. How much interest will the buyer pay at the closing if the lender uses a calendar year? And also, will it be a debit or a credit to the buyer? Including June 7th, 24 days of interest are owed for the month of June. I'm throwing that in there because it's telling you in the beginning that they have to pay the full month of July interest also. So, at $300,000, 4% of interest is $12,000 annually. To come up with a daily rate, we're using a calendar year. We're going to take that $12,000 and divide it by 365, which means you're paying $32.88 a day in interest. We have those 24 days in June, which is $789 when you multiply it by the daily rate. You have a debit to the buyer, which is not relevant to the seller. And I have an issue with this one going backwards. Hang on there, folks. Got to go back. Okay, in my mind, which I'm going to go by what it's saying here, because it's saying including June 7th, 24 days of interest are owed. That's kind of in conflict with the payment. Oh, I'm sorry. My misreading here. The loan payment is being made on August 1st, and that payment covers the interest for July. So you are only looking for the 24 days of June. I apologize if I confused you. I read fast and I made a mistake. I apologize for that. Interest proration on an assumed loan. The buyer goes to closing on June 7th. The buyer assumes the seller's existing loan balance of $286,984. So $984. I'm sorry. After the seller's payment made on June 1st. The interest rate on the loan is 4% annually. The buyer will make the regular loan payment on July 1st. What time period is the interest paid on July 1st cover? Who will be credited and who will be debited? How much is the debit or credit that will appear on the closing statement using the calendar year? So it's telling you that the interest is paid in arrears. So when the buyer buys the house and they're paying the July payment, it covers the interest due for the month of June. So if the day of closing is charged to the buyer is responsible for 24 days of interest, and the seller is responsible for 6 days. The seller will be debited 6 days of interest. The buyer will receive it as a credit, since the buyer will pay all of the interest in the July payment.
Hey, Charlie,
Yes.
it's Jill. I'm sorry to interrupt, but we've had a couple of people say that they're having difficulty hearing you. And I was just wondering if you could lean into your mic just a tad.
Sure. Not a
Thank
problem. Thank you for letting me know. Sorry about that. I'm usually considered a loudmouth, so I'll get my voice up a little bit. Okay, so you have the amount that you paid for the house, the loan balance, $286,984. You're going to multiply that by 4%. So your annual interest rate is going to be $11,000, or your annual interest paid is going to be $11,479.36. We're using an actual calendar year again, so we're going to divide that by 365 days to get $31.45 as a daily interest. And since it already told you in the problem that there's a 6-day responsibility there, you're going to multiply the $31.45 interest for the day times 6 to come up with $188.70, which is going to be a debit to the seller and a credit to the buyer. Okay, I do believe this is another polling question here. The seller has paid the monthly homeowner fee for October. If the closing is on October 10th, then the day of the closing is charged to the buyer, and actual calendar days are used to prorate expenses. What's the prorated amount shown on the closing paperwork? And you know, there's a problem with this. Nowhere in this problem do we tell you what the dollar amount of the monthly homeowner association fee is. So I think we'll kill the progress on this one, because it's kind of hard to calculate when you don't have a number. So If you would have been sitting, if we would have had in there that the homeowner association fee was $150 for the month, and I apologize because I reviewed all of this stuff and didn't even notice that there wasn't that in there. So that's a math problem that they do just for, this is a good learning point here. While you're taking the test, you do have the ability, when you're taking the license exam, to click. If you think that there's a problem with the question, you can click in on the question and ask a question, or tell them, hey, I can't answer this question because you need to review this because you don't have the homeowner association fee in here. I can't do this. And the testing group, which in Louisiana is PSI, they actually go back and review these things and will make corrections to the questions. Hopefully you already passed and this question doesn't matter, because you would wind up having to take a guess at something that there's no way you can calculate. But now that we're doing the review of the question itself, it was $150 homeowners association fee. There's 31 days in the month, so that's $4.84 a day. If you multiply that by 22 days, because the 10th is being charged to the buyer, you've got $106.48, and they're rounding. And if it's less than 50 cents, you round down. If for some reason you think because there's pennies you want to round up to 107, you can feel happy and you can be incorrect. Things that are less commonly prorated. Insurance, and the reason why that is because most of the time the seller gets a refund after the closing directly from the insurance company. But there is a long shot possibility that you might get a question on that as a closing item, and it works pretty much the exact same. It works the same way as it does a tax problem. Rent. If you get a rental question, be careful, because those are notorious for giving you more than you need. All you're looking at is how much rent is being paid for the month. You're going to divide that by the number of days in the month and figure out who gets what. If they throw in the security deposits, don't fall for it, because security deposits will go 100% from the seller to the buyer. There's no proration of that, because that is actually still the tenant's money. So here we go with a rent problem. Duplex sells for $418,000. Closing is on May 16th. Each unit rents for $530 a month. May's rent is paid in full on May 1st. How will prorated rent be shown on the closing statement if the day of closing goes to the seller and statutory year is used? Give you all a minute to Okay, we're going to go ahead and look at the look and see how the responses fell into play here. Got 38% with the $495 seller debit and buyer credit as the most popular answer amongst those that did answer, with the $565 seller credit and buyer debit is second place. So let's see what the answer really is. Okay, we're looking at $495. Oops. Backtrack that one for you there. Double click by accident. So you've got $530 rent on each unit, which I'd love to get a place that rents for $530. So you've got rent that was received by the seller for $1,060. You have that times 12, which is 12,720 days. And you've got that divided by 360 for a statutory year. And 3533 is the daily rent. And the seller is keeping the money from the 16th. So that leaves you with 14 days, which is $494.67. Rounded to the nearest dollar, it's $495. So hopefully that is relatively clear on this. The one thing that a little extra information that makes no difference to anything is that the duplex sold for $418,000. We're looking at rent. So how much the total payment for the property was has no meaning whatsoever. It's just in there, and I can't even think of a creative way to add that into the problem. Okay, recording and transfer fees. Some states have transfer fees or conveyance taxes or revenue stamps or recording fees. Like I said, I've taken the test 17 times over the course of 20 years. I have never gotten one of these as a question, but usually it's going to be an easy calculation of just one thing. So you've got a situation like this. You got a buyer purchasing a $4,000. I'm sorry, this is a poll question. A $400,000 property with the down payment of 3.5%. The remainder of the purchase price is being paid by a loan at 4% interest. Interest amortized is going to be amortized over 15 years. Transfer taxes are 60 cents per $500 of value. How much are the transfer taxes? And I will tell you, I'm not sure if this is showing on your screen or not, since we already have a few people that have answered. I don't see D on my slide. D is $480. So if anybody is coming up with 480, click on D as a choice. Okay, let's go ahead and see how y'all answered on this one. Okay, we're looking at the majority went with D that you couldn't see, $480. Kind of evenly split there, like not kind of, actually evenly split between 463, 464, and a few people that went in at 240. So your correct answer actually is the 480 that I couldn't see. So you're taking the $400,000, which is the purchase price, divided by $500 gives you 800 units that you're going to be multiplying times 60 cents, which brings you to $480 for your answer. See, where some people will lose and add a calculation and add one calculation that doesn't belong is they'll take the 3.5% down payment off and do a calculation on the loan. This is strictly based off of what the property was purchased for, not how much the loan is. Okay, here we go. We got a buyer, another poll question. Buyer purchased a $400,000 property with 20% down payment. The remainder of the price is being paid by a loan at 4% interest amortized over 15 years. Recording fees are $75 flat fee plus $1 per thousand. How much are the recording fees? Okay, let's take a quick look at the results. The two most popular answers were D and B. And I understand why both of them went that way. But let's go ahead and show the math and look at the correct answer. So you got $395 is showing it as the correct answer. You got the purchase price minus the down payment equals the loan amount. So you've got the $400,000 divided by, minus the 20% of $400,000. So 400,000 minus 80,000 is 320. Divide that by 1,000, gives you $320. And don't forget that $75 fee that goes on there plus it. So it's $395. Now, the thing about this is, because I know some of you may be thinking, well, wait, on the last one we used the sales price. The sales price was a recording fee on the sale. This is a recording fee, and this problem is for the mortgage. So in this case, you need to take the 20% down off before you do your calculation. The little bit confusing, but yeah, one of the things that when I had gone
Looks like we may be experiencing just a little bit of technical difficulty. We'll give Charlie a second here for his internet to catch up. And if the internet is
second
fighting
time.
us, oh, there we go, Charlie. I apologize. We froze for just a second there, so we may have to ask you to repeat just a little bit or summarize before we move on. We lost you for a sec.
Okay. Did you hear me okay now?
Yes, sir.
All righty. Yeah. What I was saying is the summary on all this is on this one, it was asking for the recording fee for the mortgage, which is why on this one, you were looking at taking the 20% off of the property sale because it's going off the value of the mortgage. When you were looking at the recording tax fee for the taxes, you were looking at the full property sales value. And like I said, it's something that you kind of have to catch when you're reading. And a lot of people miss questions because they read too quickly and they miss something. It's not that they don't know what the answer is, it's just that they missed a word in the question. So what I was told when I took the class was read the question, take a breath, read the question a second time. If you understood the question the same way both times, now look at your answers and go ahead and answer it. If you read it the second time and your brain goes, wait a minute, that's not what I thought I read before, then take another breath, read it a third time and go from there. You do have the ability to skip a question and come back to it. So always know that's also another thing you can do if you're just confused by it. Calculating net proceeds, which I believe is the last concept in here. You're looking at this, the seller says, okay, this is what I'm listing the house for. But as long as I get a certain amount in my pocket after this is over with, I'm happy. So in this one, the seller wants to net $209,000 for the sale after paying a 5% commission. It is asking what the property sold for. So basically what you're looking at is 100% of the sales price minus the commission is the proceeds. And then from there, if you look at it with that, 100% of whatever it sold for minus the 5% equals 209,000 that the seller is getting. So what you're saying is that 95% of the sales price is 209,000. So you take the money that the seller wants in their pocket of 209,000 divided by 95%, and the property is going to sell for 220,000. Because when you take 5% of 220,000, extending it a little further means there's an $11,000 commission involved. So you got a seller in our last poll question that wants a minimum of $300,000 from the sale of property. If the commission is 6% and the seller needs to pay off a $100,000 loan, what is the least that the property would need to sell for? Give you all about another 10 seconds. Okay, we're going to close it off and see how the results looked on this. Okay. Just over half said $426,000. And few ago, and then the next closest was 420. Let's take a look at the actual answer here. $426,000. So you've got to look at 100% of the sales price, less 6%, which is the commission, less the $100,000 that has to be paid off to come up with $300,000 in the seller's pocket. So 94% less the 100,000 equals 300,000. We're doing the negating out to get all the numbers on the same side. So 94% minus 100,000 plus 100,000 is the same thing as 300,000 plus 100,000. Oh, these are the math questions I never did like as a child. So 94% of your sales price is 400,000. 400,000 divided by 94% is 425, 531.91. And since these answers were being rounded up to the even thousand, 45, 531 is going to put you at 426. The good thing about this one, just so you'll know, because they did have two numbers that were, 420 and 421, 426 and 427, is they'll never, if they have two numbers that are within 1,000, they're never going to put the answer in between those two numbers. There's no way that this would have come out 426,531, because they want to make sure that you don't gravitate wrong when you're actually coming out with a correct answer. So what do you expect? You're looking at when you go to take the test, experimental questions. Most of the time it's 5. I've heard you could get up to 10 of them, but I don't know anybody that has yet. These are ungraded questions. Basically, they're trying to see A, how the response is, and B, if they need to work them out or do something to massage them over to make them better quality questions. And when you do get one of these, the timer that's going to be going off in the right-hand corner of your screen is going to freeze. So don't think that, oh my God, they're going to be taking away my valuable time while doing this. No, it stops, doesn't count for you or against you if you get it wrong. As far as if you want to know your total questions, passing score, all of that fun stuff, go to your testing website, your testing company's website, and they have a thing called a candidate guide. It'll tell you the total number of questions. It'll tell you what percentage you need, which in most cases is 70. And it'll also let you know inside of it that they guide what the total questions. It's going to give you an outline and tell you, here are the main topics, and here's where your questions could come from out of the main topic. Because it's like I tell people, when you look at most textbooks, you're looking at a 450 to 550 page text. If you narrow it down to where the questions are going to come from, it's about a third of that material, because the textbooks give you a lot of explanation of how things came to be and things like that. And that's so you have background knowledge. They're not going to test you on the background knowledge. They're going to test you on facts. And like I said, you can return to a question and change your response, provided you didn't run out of time. The one glorious silly thing that I was told one time was, if you don't finish all your questions, they don't count against you. That's a yes and no. If you have to get 70%, like you do in Louisiana, that's 80 questions. That means you have to get 56 right. If you are a genius and you answer 56 questions, you get all 56 right, and you click submit. The 24 that you didn't answer didn't count against you because you already had enough questions right to pass. Answer everything. Be sure. Give yourself the best possibility. And now I have a feeling I'm going to have a bunch of questions being thrown at me.
Actually, Charlie, I think that we've addressed most of the questions as we've been going, surprisingly. So,
I didn't do that. I wanted some Q&A.
Well, unfortunately, we have gone over quite a bit as well. So we are going to finish up. We're out of time for the day. You've been very, very thorough, and we can't thank you enough for that.
Jennifer, it's Jill. Jen, can I make one quick comment that we had several questions about, and I just want to make sure that it's addressed?
Sure.
Thank you. And that is the difference between in prorations. The question will tell you whether it's a statutory or bankers or 360-day year or a calendar year. Several of you had asked why we weren't using 31 days for May. In a calendar year, May has 31 days. In a statutory year, every month has 30 days. So they will give you guidance on that.
And the reason being, just to give a little background on that, is that in the world of finance, God bless the banks and the lending people, and this is what happens when you have a wife that's in mortgage. They make it a little easier on themselves. It's really for the benefit of the bankers. It's every month is equal. So you wind up with a 30-day, and like I said, I do appreciate these questions telling you which kind of calendar you're using. A lot of the questions in the test are going to say nothing, and if they say nothing about the calendar, you have 30 days, and every month that's the default.
Wonderful. And we did just have a question pop up, which does pertain to something a little earlier in the presentation. So if and we are kind of pushing the time here, but if we can answer quickly, if the buyer is getting a loan, is that a credit to the buyer or a debit? And we had this a little earlier in the presentation where we discussed the buyer borrowing, the buyer getting a mortgage loan, and whether that's a credit or a debit.
It should be a debit, because I mean it's weird when you look at it, because I think it kind of cancels itself really, because it's the loan is a debit because they're going to have to pay it back. And it also shows up on the other side.
It's Jill. It's Jill. What we're talking about is the buyer's new loan here. So on the balance sheet, the buyer is debited the purchase price. And since what we're looking for is the total amount that the buyer will need to bring to the closing table, okay? Since you're looking for that, they're debited the purchase price, and then they're credited back that loan. And so we're working backwards to get to what
they need to bring to the table.
Exactly. Anything that's paid on behalf of the buyer is a credit to the buyer, including their earnest money deposit, including the loan that the lender stands. I'm sorry, I'm going to shut up. I talk too much.
No, you're doing fine.
Okay, wonderful. Well, thank you so much for the clarification, Jill. And we have had a couple of questions as well about whether we'll be sending these out. Remember, we will be sending out this recording as soon as it's ready. And anything specific to your state, the percentage of questions that will cover calculations, all of that will be in your state's candidate guide, as what we've covered here has been national. So other than that, I think that we have covered just about all of the questions that have come in. And we've got some really great content here. So at this point, Charlie, unless you've got anything else that you'd like to interject.
I'll give a real quick closing remark. Since I know some of y'all, once you get the recording, this will be reviewing, we'll be reviewing. If you happen to come up with another question that you didn't think of when you saw it, when we just went through, feel free to reach out to us. I'll say it as an us. And if the team doesn't know the answer, they'll turn around and get back to me, and I will give you an answer for it.
Wonderful.
Other than that, thanks for being here, and I guess that's it.
Yeah, Charlie's absolutely right. The CE Shop is here to support you guys whenever you need it through the support function in your course home. So please do feel free to utilize that. We've got support at the CE Shop. We've got a phone number, instructor at the CE Shop. We've got the chat feature through your course. So you are supported. Please feel free to contact us at any time with any questions that you might have. And at this point, we're just going to say thank you so much. We appreciate you all being here today. And I'd like to thank you again, Charlie, for joining us today. Your knowledge, expertise, and the willingness to share it with our student community, greatly appreciated. Thank you so much. Please, everyone, look for an email from us with a link to today's recorded session, and keep an eye out for invites to additional webinars in the near future. When this webinar ends, we invite you to complete a survey. If you're able to take a minute, we would love your feedback so we can continue to provide valuable webinars to you. Thank you again for joining us today, and we will see you next time.